a lot of conversations around tokenization, around institutional adoption of digital assets, the overlap between TradFi and DeFi, and as you have heard Mr. Paul Chan speak yesterday, this is one of the key focus areas for Hong Kong as a financial market. We have a very distinguished panel of guests today to talk about this theme, and I'll be diving in quickly, but maybe we can have each of you just very briefly mention your role and what your organization does, in particular around institutional digital assets. Bura, we'll start with you.
Yeah, my name is Bura. I am looking after digital assets and currencies initiatives at HSBC at Global Macro, including FX, commodities, rates, and maybe some recent news that you have seen already. In the UK, the digital bond issuances will happen on HSBC's Orion platform. This is the latest.
Thank you. Georgia?
Hey, Mushir, thanks for having me. Hi, everybody. My name is Georgia. I oversee the custody business line, head of custody at xTrust, and chief product officer. xTrust is a leading financial service provider and infrastructure provider for digital assets. That means that we provide institutional clients all the way from what we call digital asset natives, say blockchain foundations and investors, all the way to the opposite spectrum, say corporates. We provide them with custody services, staking, markets execution, and more. Thanks for having me.
Thank you. Philip?
Hi, my name is Philip. I'm the CEO of Emergo. Emergo is one of the founding entities of Cardano. Our focus nowadays is really on commercialization of blockchain, specifically around RWA, which is, I think, why I was asked to join.
Thanks. Andrei?
Yeah, hey, everyone.
Why don't you use this?
Yeah, hey, everyone. My name is Andrei Grachev. I represent here DWF Labs and Falcon Finance. In terms of RWA, we do a lot of DeFi, kind of collateralization of these assets and create synthetic dollars. Also, at DWF, we invest a lot in real-world assets, tokenized real-world assets, and we do trading on gold, physical gold, tokenized gold, and since right now exploring issuing some banking cards and some like Genius compliant stable coins, yeah, and many other things. Thanks.
Thank you. And talking about tokenized gold, Bura, you've had that distinction of leading HSBC for the tokenized gold. What I want to ask is, it's been almost 2 years since that product launched. How are you seeing, broadly speaking, the maturity for RWA adoption by institutions, both at HSBC's level, but also with your clients and partners?
Yeah, so gold token, it's not even 2 years actually. It's been 22 months exactly, and it's been adopted very well. Right now we have over 1.5 billion USD traded value with over 190,000 trades. And 38% of the gold token investors are new to investment. So it shows that the product is very attractive to Hong Kong clients, definitely. And in terms of the maturity and everything, I think we can look from the two angles. One is the regulation. Last year, 2025, saw significant developments in the regulation space. In US, Genius and Clarity Acts set the comprehensive framework for stable coins and cryptocurrencies and the tokens. In European Union, MiCA, markets in crypto assets, got operational and started issuing licenses. In Hong Kong, we have 11 licensed virtual asset trading platforms, stablecoin ordinance in effect, and last September, the first batch of the license applicants submitted their applications. And yesterday, actually, there was some news that we might expect to hear the initial result in March. This is the regulatory perspective. What about the clients in terms of maturity and adoption? Every year we conduct customer research. In Hong Kong, last time we did research, but I will go back first to 2023. When we ask customers, have you ever invested in any kind of digital asset, crypto, NFT, stablecoin, or tokenized gold, whatever. Only 9% of the clients said yes. Then we asked the same question 1 year later. Then it was 15%. We asked the same question last year. It was 19%. It is growing. And Hong Kong customers, especially in Hong Kong, people are very open to new innovation and new technologies. They embrace it. And there is one thing for certain, we are in a strong growth trend.
Thank you. Georgia, you're also present across the region. Hextrust is licensed in a few jurisdictions. And you deal across both sides, right? Not just institutional side, but also on the DeFi side as well. So how are you seeing the adoption of RWA, both from an institutional perspective, but also from a DeFi world, if you may use that term? Yeah.
Oh, very good question. So first of all, I'd say we're definitely, back to your point, right? We're going in the right direction. It does make me smile that our first involvement in RWA was actually back in 2021. I just saw Scott Thiel, former DLA Piper. It was together where we basically did a issuance of, unregulated issuance of tokenized bonds. So 2021. So that's 5 years ago. Yeah. So obviously lots of ups and downs. Right direction. We've moved away from proof of concept for sure. Are we anywhere near close to a integrated RWA ecosystem? Not really. I think there is still road to cover. And in terms of also what helps? Okay, what helps in that direction? What we see helping. Obviously, it's all the benefits that we've heard before, capital efficiency, operational efficiency, et cetera, et cetera. However, I would say that when you see large institutions moving in a coordinated fashion, for example, DTCC planning to tokenize this year, I think around middle of the year, hundreds of billions of dollars in treasuries, right? When you know that multiple banks have invested in specific blockchain ecosystems because they have a concrete plan. Other blockchain ecosystems, they feel the pressure and they really accelerate. And this is almost like a positive cycle that really gets things moving. So that is on the side of tokenization. Obviously, tokenize is one thing. Then what are you going to do with those tokenized assets is the other side, which brings us to DeFi. So institutional DeFi still also is quite far, to be honest. What does institutional DeFi mean? It means really being able to basically deploy these tokenized assets into decentralized applications where there are numerous inherent risks to it. Then the question is, where should the application live? As a public chain? Is it a private chain? Do you want privacy? Do you want control? Do you want to... Obviously, public blockchains are a lot more battle-tested than the private ones. You want interoperability. So I think all of that still needs to be covered, but direction is right.
Thank you. Philip, I'm just going to build on that with you, right? We've heard from an institutional perspective that technology is an important piece to all of this, and you've spoken about how one of the goals is looking to bring more RWAs on chain. How are you seeing the maturity of projects that are coming on chain, especially when it comes to RWAs, and are you seeing more institutions engaging with public chains per se?
So how I think about it is not dissimilar to what our other distinguished panelists have said. I break it down into 3 C's, right? You need proper custody. You can't tokenize all of this stuff on chain without safe custody. You need compliance. Without proper regulation, rules of the road, you will never get institutional adoption. The third thing that makes it worthwhile doing, because otherwise you're just tokenizing for tokenizing's sake, is a degree of composability. If you can't compose these assets in a different way from traditional asset holdings, then why do it, right? And so what we're seeing is you have proper custody, you have increasing compliance, which gives us clarity on how we can act. Composability comes from folks like DWF who are, frankly, geniuses at doing this type of stuff. but you still don't have true size coming in, right? So we're still very early. And so I think what will be the breaking point or the tipping point is we've heard chain abstraction. We need to have token abstraction. People don't need to care that it's tokenized. It's just buying a asset in a more sensible, faster, ease that is mutable on chain, right? Which helps you have public record and auditability. So that's how I see it. We're still not there yet.
Thank you. Andrei, what are your thoughts, especially looking from a investment trading kind of element? How mature are these?
I agree that we're very early, and if you take a look at the whole tokenization, reward access tokenization process in the crypto space, right? That's right, that it started not yesterday, not today, it started years ago, but it was not much clarity in terms of regulation, and the market was not ready, right? Now market is getting more mature, and the best examples of tokenization things is, for example, xStocks, tokenized stocks that gained a lot of traction last year and is keep growing, right? Another example is Tether Gold, for example. Trading volumes, AUM is growing, which means and which says for us as for investment firm, a trading firm, that these assets that will be tokenized next, this is publicly traded assets, because people want to trade things seamlessly. For example, you trade BTC with Tether, with Circle, doesn't matter, and then you swap from BTC to gold, trade gold, swap to stocks, trade stocks, swap to something else, and exit or pop up your deposits, right? But again, there are many things to be tokenized, to be developed. For example, private credit, bonds, future yields, contracts, right? Pre-IPO stuff. And everything requires not only framework, but counterparties that will make sure that underlying is secured and you can get it, right? It's a question to custodians, but also to a proper custodians, right? Let's ask, for example, Hex Trust, if they can handle custody of, I don't know, some rare earth metals mining farm, right? It's a hard question because maybe yes, maybe no, and this question should be answered. Yep.
It's a fair comment, right? So at FinStep Asia, we work with a lot of institutions and policymakers. I'm an ex-regulator with VARA. And what we've seen over the last 5 years, I think the conversations have gone from, we want to know more about this, to how can we build this, right? And building on the panel's insights, is 3 key elements you can talk about. One being regulations, where you have a regulatory framework for both institutions, financial institutions to get into tokenized securities and other elements, and regulators like HKMA engaging in tokenized products. Number 2 is the maturity of the technology. You rarely hear about, can any blockchain not handle scale and volume right now, right? Most people are. And number 3 is, of course, once BlackRock enters the room, you can't even call it an elephant, it's probably a mammoth when it enters the room and says, we want to tokenize everything. As the world's largest asset manager with over $12 trillion of AUM, you then know that this is moving towards more concrete aspects. And Andrei, I want to build on this conversation where we have seen a decent amount of primary issuance of RWAs taking place, right? But one of the challenges that gets spoken about is secondary markets and secondary liquidity, right? And in Singapore, MAS is working through Project Guardian and a few initiatives to try to drive that. But where do you see a non-regulatory driven secondary market? How liquid is this? And is this still a major challenge for institutional investors, let's say maybe especially from the traditional world, when it comes to wanting to enter RWA as a portfolio versus just doing a primary purchase? Thoughts? Andrei? You have thoughts?
Frankly, in terms of liquidity, right? That's markets that are liquid on traditional space, let's say stocks and gold, they are very liquid on crypto space. But if we expect to, for example, real estate to become liquid on crypto, no.
Georgia, do you have any views on this? I agree fundamentally. So we need to split RWAs between, let's say, financial and non-financial, right? So financial RWAs, tokenized stock, bonds, funds, etc. These are instruments that investors are familiar with, and they have a clear one-to-one mapping between how they would work in their tokenized form, more or less, to how they work in the traditional capital markets. Now, think about, okay, real estate, commodities, IP, carbon credits. How do you value those assets? The investor base is fragmented. Jurisdiction-wise, it's not very clear. So there, obviously, the liquidity challenges are going to be very obvious, and we see them. Yeah, so I agree.
Philip, you had something to add?
I would just say the only way, like, tokenizing doesn't make something more liquid. I think everyone should understand that, right? It's pretty clear. But how you increase liquidity, number one, you lower the cost of entry, right? So if you're doing like tokenization of reinsurance, for example, that's a space that you need $100 to play with. Retail doesn't operate in reinsurance, but it's a great asset, right? So you lower the barrier to entry. You make products that are currently not available to a subsegment of the population, the investable population, that is compliant. That is the type of innovation we're starting to see in the space, but it's not going to register on the scale yet, right? Which means, look, there's validity, there's value. It'll just take time, education, and it will probably be the last thing that people get on chain and figure out how to do, right? The first things are the things that we've done already, money market funds, Tesla, right? But to me, that doesn't really move the needle. What makes this really interesting is when we start tapping into the less liquid stuff, personally. That's where we play.
I think that's a good point to add in terms of the distinction between tokenization and fractionalization. Not all tokenization equals fractionalization, right? And when you do fractionalize it, it doesn't mean that something super illiquid and something that market doesn't have an interest will suddenly become more liquid because it's now in multiple fractions, right? Property is a classic example. Hong Kong real estate, you had a lot of, I won't say a lot, but a few real estate developers who were very keen in exploring tokenized property in Hong Kong, but you really haven't seen anything happen. One of the drivers is property prices fell 30% from their top. So there's not going to be so much attraction for a slightly distressed asset, as it were, right? Or a market. Now it's picking back up, maybe there'll be more interest in it. So I think that's an important element to keep, that if you don't have a highly attractive asset, fractionalizing it is not going to change it. Fractionalization may increase the velocity if there is a large asset which more people want to invest in but don't have access to. And building on this in terms of, Philip, you were talking about the overall infrastructure conversation, right? And I want to dive into this, I wouldn't say the battle, but the contrast we have with regards to permissioned and public chains, right? And fully private chains as well. And the RWAs are, for institutional adoption, are between the three in some senses. Where do you see most traction, and what would you say would be the strengths of each?
I think Georgia spoke a little bit about this, so I'll kind of just build off of that on what I think is truly missing for true adoption to take place. I don't think anyone in this room would, if I knew your wallet address, I know exactly how much money you have, what you transacted for the last 50 transactions. Nobody likes that, but we all track it, Nansen Smart Money, et cetera. So what's the core primitive that has gotten some degree of traction in our space, and there's very few things, is privacy, right? So having a privacy-enabled, smart, compliance-enabled chain that is an add-on to the existing L1s or can interoperate with the existing L1s, I think will be the powerful combination. You need a public chain and you need a degree of privacy. I think if you go private chains, there will always be a place, I suppose, for specific purpose-built privacy chains. But I think for true adoption, and I'm from Cardano, right? So I have a horse in the race. But I think ultimately there will be a select number of L1s that survive that will need to enable privacy for them to really get traction in RWA.
But I want to ask you this question as well, because with an institution the size of HSBC and your retail and broader professional investor base as well. How have you approached the public versus permissioned versus private conversation? And now with the announcement around Orion and the UK tokenized bonds, your thought process on that?
Yeah, so UK digital bonds or the Hong Kong ones, HSBC Orion itself is on private chain. And also tokenized gold is also on our private chain. The main consideration around there is the potential risks of public chains, especially around KYC and AML. Of course, there are technical developments around this to mitigate it potentially. I mean, with a strong design of infrastructure and smart contracts, there could be some potential mitigations, but not like a complete mitigation of these risks. So that's the main approach, because we are not just trying to do a Web3 application or a token, but we want to make sure that whatever we do with the technology, whatever the technology enables, meets the client needs. So we approach from this perspective. Having said that, last year, the EHKD plus participation of HSBC, we conducted the pilot on both public and private DLT environments. So it's already something that we have been exploring, but this is the status right now.
Thanks. Georgia, coming to you.
Maybe I'd like to add something on this one.
Yeah, I was going to ask you to also
okay.
add and I'll ask the follow-up question. Go ahead.
So, completely agree with Philip. I think only a few chains, especially when it comes to institutional focus, only a few chains will be there eventually. What is really important is that I think we need to move on from the idea that people will need to move their liquidity from a chain to another. No. I think people like ourselves, but in general, all the market participants that want to tap into that capital, they need to deal with interoperability. They need to deal with cross-chain availability. So maybe, I don't know, you're using tokenized securities on one chain as collateral for something that happens on another chain. And an institution shouldn't care, honestly. That should be all abstracted away. So that's the first comment. The second one, especially when it comes to public chains, gas fee optimization. You can't be on a chain where, I don't know, a new game launches and then, gas fees or whatnot, like there's crazy spikes. It's very difficult to work with that. So somehow, whether obviously there are roadmaps on different ecosystems to sort of bring the cost down or stabilize it, or handling in completely different way, as we're seeing some new ecosystems that are sort of isolating and managing to basically sort of have different almost environments within the same protocol. Yeah, I think these two main considerations, but ultimately, not only institutions, but also from a regulatory perspective, it has to be tech agnostic. Things should be shaped around outcome and efficiency, not so much what is the tech underneath.
So if you had to add to that, what would you say are the top 3 factors or considerations an institution has to keep in mind while picking an infrastructure partner for tokenization?
It should be agnostic. It should be tech agnostic, right? Speaking ourselves, for example, being regulated, well, if we want to be licensed, custodian, probably we cannot choose MPC as an example, right? We have to be HSM, at least right now. Do I believe that that's how it should be? No. I believe that MPC, as an example, should eventually develop institutional standards that can attest to the quality of that algorithm. MPC is super complicated because it's not tech per se, it's not hardware, it's an algorithm. Literally anybody can code an MPC algorithm. So it's very difficult to attest to that quality. But eventually one day, whatever is the safest and the most interoperable way to allow the market to become what it needs to be, which is a better version of what we have today, that will have to be the standard.
Thanks. And you touched on regulation, and I think that's a key factor that's flowing in is regulators have been, in some senses, been very prescriptive in what can be done and how you do it, like you mentioned, HSM versus MPC, while we're also seeing a conversation where they're starting to move towards a more principle-based approach because you now have a variety of different ways of executing things. Andrei, what are you seeing, or what would you say are key regulatory or legal blockers or challenges, if resolved, could help with more institutions coming on chain with RWA? Your thoughts on that? What would you like changed? Are you happy with what's happening? Doesn't have to be that you need things changed, but yeah.
Frankly, the direction that we have now in the world is, from my point of view, is great. And the US Clarity and Genius Acts are very great examples of this. Also, Middle East, like UAE, does a great job in terms of reward assets tokenization and crypto frameworks. We also established here. Also in Hong Kong, you can do many things, right? And basically, I would say that it is not like some virtual institutions that have the same appetite for everything, right? There are many institutions. They have different views, different needs, different requirements, right? And for example, people who use USDT to trade goods, let's say, from China to the rest of the world, it's also kind of institutions. And so for them, this reward asset revolution already happened. They use stable coins to buy and sell stuff, right? But then on the other side, right, we can take a look at the US, right? But there is some new things happening and many other things are to be developed. Or El Salvador, for example, one of our portfolio companies are getting a reward asset tokenization license there. El Salvador is a small country, but the framework and example is great. And I think direction is good, but we need just a bit more time and yeah.
Thanks. Buddha, your thoughts on what are some of the regulatory friction points that need resolution or upgrade for more institutions to come on board?
I think from an innovation perspective, innovation always outpaces legislation,
Sure.
regulation. So we will, if we're doing it right, we're ahead of that. If we're doing it wrong, we're behind that, right? And we're doing things the old way. So number one, we should accept that we're going to innovate ahead of legislation, regulation, etc. But what gives me confidence is we've clearly moved from regulation through enforcement to regulation through legislation, right? Which is a net positive. Everyone in this panel is a white hat, right? We want to do things properly, we want to do things right, we enjoy our freedoms. So knowing that we're in a regulation through legislation environment right now, we should be innovating faster. We should take more risk. And I see that happening. I see it happening with institutions like HSBC, who I would comfortably say is the most conservative of the bunch of the panelists, and folks who are kind of in between, let's say a Hex Trust in a respectful way, but in between, and probably Andrei would be on the edge of it and innovating faster, right? And so I think it allows all four of us to be on stage and talk about the same topic in a very intelligent manner. So I think that is a fundamental difference from last cycle. Will that persist? Will that kind of aggregate or kind of coalesce around a few global hubs? That's really up to the regulators, right? You know, I don't work there. If Hong Kong wants to lead, they are more than welcome to lead. The capital will follow. If Dubai wants to lead, the capital will follow. It's quite simple. And if you're going to be a less, let's say, inviting environment, we won't go there.
What are your thoughts?
I can add very quickly. I think, especially with the recent developments, like mentioned last year and before, we now have further clarity in regulation. Now it is time for us to reflect on this and identify the products and services to meet the rising client demand within this, of course, regulatory framework. But I think more importantly, I agree with all of the panelists here. There were very good points around we shouldn't just tokenize something and then think that it is magical touch kind of thing, because just because you are tokenizing something, it doesn't change the nature of the underlying asset. The underlying asset is still, if it is gold, it is still gold. If it is fund, it is still fund, and it exists in the real world, and it still needs to be it needs to comply with the respective regulations. So I think we are in a stage that, okay, now regulation is now clearer. Okay, what are the products and services that you will provide to serve your clients.
Thanks. And building on that from a regulatory and legal perspective, 3 things to keep in mind in addition, right? Number one, we have very few jurisdictions where you're seeing a decent level, I wouldn't even say holistic and comprehensive level of regulations covering everything on both sides, from the DeFi side as well as from the tokenized financial product side. Hong Kong, Singapore, Middle East in terms of UAE, MiCA, and probably now you're seeing with FCA. US is on the way with Clarity Act, and when that comes in, that'll probably be there. But that's just still a very small handful, right? You can add Australia to that list. But globally, that's still an evolving process. So for large institutions, that's going to be another challenge. You'll be confined to operating in certain jurisdictions and likely only in 1 or 2 jurisdictions based on those rules. So harmonization is going to take time. And that's seeing a big challenge for major institutions who are regional to enter it. Second piece is on RWA, specifically the legality question of the digital twin. So you may have a token that represents a property, for example, but is that transfer recognized legally on the land records, right? So that needs changes beyond financial services regulations, needs changes on property and land regulations as well, right? So this is a big friction. Even in Dubai, where they're running POCs with Dubai Land, this is to be solved, right? And number 3 is the conversation where you will see certain products that are inherently cross-border, like stable coins, and then jurisdictional oversight becomes a question. Say a token issued, a US dollar stablecoin issued in Hong Kong is being used in Thailand or in the UAE. If something goes wrong, who has jurisdictional coverage on that? Sometimes it's dual, and how the regulators harmonize is going to be a big question on RWAs as well. Before we come towards the end, what I want to ask you and Georgia maybe you can start with that, is for a lot of, when you're considering RWA, there's a lot of risk factors involved, right? And how comfortable are institutions, or what do institutions want to ensure that when they're engaging, they're compliant with existing regulations, but also have done the right risk frameworks in place?
Yeah, that's a good question. Okay, the one side is what they want. Okay, what do they want? All right. They want to be able to take what they do every day and know that they will be able to enforce the same framework, knowing that underneath the rails are different. I think if we are counting on rewriting compliance SOPs and frameworks and policies, same for risk, to make them fit a technology is wrong. We're not going to go very far. They need to be able to have clarity over ownership, bankruptcy remoteness, as you said, legal accountability. When something goes wrong, where do we do? They cannot operate, and they will not. We're not going to see meaningful movement unless access to these facts, to this truth about these assets are readily available, easy to digest, easy to deal with. These, to your point, right, about you take a specific asset, for example, tokenized RWA, the ramification of the level of integration in existing systems, they all need to be there, because they don't want to worry that, okay, we're doing this, maybe it's a pilot, is fine. Then you want to go to the real world where things are on mainnet, on chain, there are consequences that probably are not even, you cannot even simulate it to the full extent. You just don't want to have that uncertainty. So until probably starting with the simplest assets where things are predictable, that's the way to go. But in short, I would say they want familiarity. They don't want to rewrite how they build their operations because of a change in technology. Thanks.
What are your thoughts? Of course, as an institution, you have dual role, right? You need certain things at certain level, and your clients also need certain...
Yeah, of course, the risk approach and the assessment of it is one of the most critical part for us when we launch a product or service. And as mentioned, the key risks, the main concerns around especially public chain, are the potential risks of KYC and AML. And again, there are technologic solutions to potentially mitigate them. But actually, Mashir, you made a very, very good point. The legal part. Because when you tokenize something, it doesn't change the nature of it. It's still the underlying asset. And especially when you build a first-in-class product, you don't have any benchmark to look at and get inspired from. You should invent things. You should build things from scratch. And especially in the legal and regulatory compliance aspect, it should be taught from the early stages of the product development. And the other risks, I think, same risks, same regulation, same approach, right? So same activity. So that's why liquidity risk, market risk, cyber security risk, and Georgia mentioned many technologies, etc. They can be potentially sorted, but especially identifying the legal aspect of it is very, very critical.
Thank you. And just very quickly on those, one of the other things is risk controls, right? We've seen what happened with Bithumb over the weekend, where there was a fat finger error, where instead of Korean won, they entered Bitcoin numbers, right? And that didn't go, I mean, it did have a big impact locally in Korea, but that's kind of examples which wouldn't necessarily happen in traditional finance, or there are very strict controls in place and fines, etc., alongside which we're still seeing evolve. We've come towards the end of it, so I want to get a quick 20, 30-second view from each of you as what you feel is the most important element, initiative, person, whatever you think, important thing for RWA in 2026. We'll start with you, Burra.
We should be where our customers are. We need to listen to them, and we keep designing products for our customers. This should be the number one.
Customers first. Georgia?
Very good point. But as a custodian in Hong Kong, the license, please.
Soon, hopefully, fingers crossed. Philip?
I would say patience. You know, this will take time.
I believe that business first. You make money, the rest will follow.
So thank you so much for all of your wonderful insights. Very insightful panel. And our speakers will be available to have a conversation offshore. So thank you so much. Thanks.
Thank you very much.